Okay, I'm Jordan Roy-Byrne. I write a newsletter called The Daily Gold. You can find all my work at thedailygold.com. If you have an email, feel free to email me at jordan@thedailygold.com. Of course, everybody has an email by now. What am I talking about? So thanks everybody for coming. I really appreciate you attending. And today I'm going to discuss gold, uranium, and discoveries. So let's get started. So as we start here, there's three things that I just want you to remember from this presentation, because I know that if you've been here all day, you hear many presentations, there's a lot of information that you listen to, but you probably don't retain most of it. In fact, you probably retain none of it or maybe a little of it, to be honest. So there's three things I want you to take away, three things you have to remember. And even though I assume everyone can read, I'll just help you out and read them all just in case. And this is what I said in my presentation in May. The gold bull market, the next bull market, it's not going to begin until the Fed is done hiking rates. So the Fed is still hiking. Whenever they stop, that's when we'll see gold start to outperform equities again in a new gold bull market, especially if they cut. If they stop hiking rates and they go into a new cutting cycle, that will be very bullish for gold. We'll get a strong bull market like we had in gold stocks, like we had in the 1960s or the early 2000s. Number two, uranium stocks could be on the cusp of a bull market. I'll talk about that a little bit more later. And then lastly, focus on exploration and discoveries. That's obviously where money is flowing in the sector. What metal they're looking for, it doesn't matter that much. I mean, obviously I focus on gold and silver, but so if you're looking at gold and silver, focus on exploration and the companies making discoveries. Now, the major fundamental driving force for gold is declining real interest rates or negative real interest rates. Supply and demand, geopolitical stuff, that's all nonsense. It's really meaningless. It comes down to monetary factors, and for the most part, it's real interest rates. And you can see in this chart here, I have several different measures of real interest rates. If you look at the ones at the bottom, that's just using the simple CPI. And over time, I find that those are more accurate than the market itself. The real TIPS yield, that's kind of a market estimation of real interest rates. So the market has been estimating real interest rates have been going up. That calculation has been going up for the last couple of years. It's at a 7, 8, 9-year high, something like that. If you look at the simple calculations, real interest rates, it hasn't been as strong as the market calculation, but they've still been going up. So the fundamentals for gold, and also if you look at how's gold performing against the stock market, how's gold performing against foreign currencies, it's just ugly there. In fact, the gold price, recently we've had some dollar weakness, and the gold price has done nothing. It hasn't been able to rally. If we look at gold priced in foreign currencies, at the end of last week, that just made a new 2-year low. So the fundamentals for gold are still bearish. When are they going to turn bullish? I'll just go back to what I said before. When the Fed stops hiking, that's when things will start to turn bullish for gold. And going back over the last 60 years, I'm using gold stocks because gold's trading history obviously starts at 1971. Gold stocks have a much longer trading history. So looking back over the last 60 years, as far as the end of Fed hiking cycles or the start of new Fed cutting cycles, there's been, I counted 12 different rate cut cycles over the last 60 years. In 10 of those, the average gain for gold stocks was 185%, and the minimum gain was 54%. The strongest gains were in the 2000s and the 1960s. So even though this is an important point, if we look at long-term bond yields, maybe we're turning up to a new uptrend for the coming decades for bond yields. That was the case in the 60s and 70s. And for most of that time, rates were obviously rising, but when they started to go down, when the Fed started to cut during that period, for the most part, it was when the Fed started to cut, that's when huge moves started, because they started to cut and then inflation really took off. So I just wanted to make that distinction. And I mentioned this in May, and I want to mention it again. What happened from 1999 to 2001, there's many similarities to what's happening now and what's been happening over the last couple years. And in this chart, I have the Fed funds rate at the top, gold stocks, gold, commodities, and then the S&P. And really, what we're looking at is when the Fed started to hike again, when they stopped, and when they went to cuts. So it's interesting because when the Fed, prior to 1999, the Fed wasn't doing anything for a while, and during that period, you had a really bad commodity bear market. So it's really similar to what happened in recent years. We had a really bad commodity bear market, and then we had this bottom in early 2016, and the catalyst for that bottom potentially was the start of the new hiking cycle for the Fed. But what happened then is you had the start of a new cycle in hiking rates, and gold stocks actually popped a little bit after that hike. Commodities popped, they kept rising. Of course, the S&P kept rising the whole point. But when the Fed kept hiking in 99 and early 2000, that's when precious metals trailed off. I mean, they kept going down after that, and that's what's happened in this cycle over the last year or two, or at least, the peak was 2+ years ago in summer 2016. But, what changed things, what turned it all around? It was when the Fed stopped, they stopped their hikes in the middle of 2000, and then eventually they started cutting rates. And in the middle of 2000, that's when we saw, if you look at gold against the S&P, gold against the stock market, the middle of 2000 is when that started to bottom and turn up. And so in my work, I also talk a lot about, how's gold performing against the stock market, how's gold performing against equities, and the Fed and their hiking cycle and their cutting cycle, it ties in, because if there's a problem in the economy and the stock market rolls over, stops going up, what's going to happen? The Fed's going to stop hiking, then they're going to go to cuts. That's what happened in 99, 2000, 2001. And so we could see that happening again, over the next, I don't know, is it 9 months, 18 months, 1 year, 2 years? We can't predict the future, we don't know. But again, it goes back to the point, as far as market timing, when do we really want to be in gold and gold stocks? It will be when the Fed stops hiking, because at that point, they'll sense problems in the economy, problems in the stock market. They stop hiking, then the market is going to look ahead and see that they'll cut at some point. That's when money goes away from equities and into gold. That'll happen in the next couple years. That's what happened in 99 to 2000. So next I want to look at silver and a potential comparison to, as far as what's happening now versus what happened from 1997 to 2001. And you can see how similar these periods are, because they started with silver having a pop, then there was a sharp correction, then it consolidated, then it broke down from the consolidation and went to a new low that was a major low. And so, perhaps, I shouldn't say perhaps, but we're in that breakdown stage. And if we look what happened, the low in 2001 was a little bit below the 1997 low. So potentially, we could see the weekly low at the end of 2015 was $14. So potentially we could see silver come down to, I still think it's, as far as the very short term, it might have started a rally today, but ultimately I think it's going to go lower, probably 13 or 12, something like that. And silver might be the leading indicator for this cycle, the next cycle, just because silver peaked before gold, and silver had a really, it's been underperforming gold. It had a really weak rally in 2016 compared to gold, so keep an eye on silver. It could be a potential leading indicator. And the analog comparison now to the late 90s, it looks fairly similar. And I put that together starting with the, after the 98 peak and the 2016 peak. And what we see is that silver, in black, that's right now. So right now it's already broken down, well below the consolidation low. And the same thing, but when that started happening in blue, you can see when it broke down to a new low, it wasn't that much longer when it made the ultimate low. So, I don't know, is this going to go all the way to March 2020? Obviously, we don't know. We can't predict the future. From eyeballing it, my guess was maybe we have another 10 months left, but again, that's just a guess. That's nothing to trade based off of. And so moving on to gold, this is another comparison. It's not quite as good of a comparison in my opinion, but when gold had this trend line break in the, I think it was 1983, after that trend line break, it then made a significant bottom 14 months later. Now, the trend line break was at the end of May, so we're again, if it's another 14 months from May, that means it's 10 months from now. So interesting how both, the silver comparison and this one say another 10 months. Okay, I want to talk about the COT, the Commitment of Traders report, and there's a lot of, I don't want to say bad information, but there's bad information analysis out there as far as the COT report, because all the gold bulls, they see how low this has been getting, and they say, oh, this is great, we're at a 17-year low, the last time it was this low, it was 2001, and that means we're going to have a massive rally. Not necessarily, because if we look at what happened, look in the 80s and 90s, how the net speculative position came, all the way down to minus 30, minus 40%. It happened quite a bit. And, we have gold that's trading around, it's trading around 1,200 now. And, if it comes down to 1050, what do we think is going to happen to the net spec position? It's probably going to come down and get negative, which that means the speculators are net short. Actually, a couple weeks ago, they got net short, but just by a tiny amount. But we have to understand that speculators, they're following the trends. And the trend in the market for gold, the primary trend is down now. So the bullish analysis of the COT is thinking that, we're looking at history and we're thinking, okay, well, the net spec position can go back to 30 or 40%. And that means gold's going to have this big rally. But that implies that the speculators are going to come in and buy and push the market that much higher. But the market has broken down. It's below all the major moving averages. It failed to break out. The fundamentals are not bullish. So why are the speculators going to suddenly get really bullish on gold? They're not going to get bullish on gold until it makes a big move up. If we look at what happened in 2016, we can see that low. Suddenly the speculators got really bullish and they were able to push gold up. So the COT has to be analyzed within the context of the overall trend in the market. And the trend in the market is clearly down, and speculators, what's their incentive to come in and suddenly buy and push this market up? It's not going to happen. So that the conventional analysis of the COT, that's what it's missing. The speculators follow trends. And if we see, at some point we'll probably get a snapback to the upside, but if we see gold go lower, we're going to see the speculators short more, and this position will come down even further because they follow trends, and if the trend's down, they're just going to pile in on the short side. So ultimately, fundamentals and technicals are really the most important, and the COT is not really, it can be a very short-term driving force. If we look at what happened in 2016, yes, the COT was at a 15-year low, but the reason gold went up is because real interest rates in 2016, they peaked and they went down. So that was a favorable fundamental development for gold. So again, getting back to fundamentals, when is gold going to bottom? That's going to be when the Fed stops hiking, and that's what you need to know, and that's going to happen regardless of whether the net spec position is at 0, 3%, minus 20, minus 30%. So just something to keep in mind. Okay, so with respect to bond yields and the yield curve, we have the yield curve there at the bottom, and what's bearish for gold in the yield curve is when it's flattening, as it has been for the last several years. What's bullish for gold is when the yield curve is steepening. So, in one point about the inversion, I mean, gold bulls will get really excited about the inversion, but there's kind of a lag time between when it inverts and then when the stock market peaks, and when gold benefits from softer Fed policy. So, as far as the inversion, that's not necessarily, I mean, it's an important signal, but it's just one of several dominoes that could lead to the point when the Fed changes its policy and stops hiking. So it's a steepening yield curve that's bullish for gold. And so what that implies is the yield curve can steepen for two reasons. You can have the Fed aggressively cutting short-term rates, or you can have inflation really taking off. So that's one of those things needs to happen for the yield curve to steepen. And where we are here and now, we could see a significant upside breakout in long-term bond yields. And I don't think that the breakout itself is bullish for gold, but eventually it would be, because it would lead to factors that are bullish for gold. If we have long-term bond yields breaking out, and that breakout move has momentum, and yields keep moving higher, that will be negative for the economy, it'll be negative for the stock market, and eventually bullish for gold. So it's definitely something to keep your eyes on, but the initial, if long-term bond yields do break out, I don't think it's going to be the breakout itself that's bullish for gold. I think it'll be what the breakout in the higher yields cause as far as the economy and the stock market. Okay, so uranium. Let's talk about uranium juniors. The uranium stock ETF, URA, they dumped a lot of the uranium juniors, and they kind of changed the configuration of the index. So right now, in that index, there's only 2 uranium companies that are in it. So I created my own index. I made it cap weighted, and I looked at the 10 or 11, biggest uranium juniors, or ones that had the biggest uranium resource. And as you can see here, we have it charted in the US dollar and in Canadian dollars. It's not updated today. These are weekly bar charts, but it looks like the uranium juniors could be on the cusp of a significant breakout. And so speculative capital is starting to flow into this area, and maybe that will continue. The one thing is, I'm not sure, I think there's 2 scenarios. The first is that we get a breakout, and then all this money comes in uranium stocks, have a huge run for like 6 months, and then they come back down for a while. The other scenario is this breakout is the start of a multi-year bull market. I'm not an expert on uranium, but my guess would be the first scenario is probably more likely, where we get a huge breakout, tons of money piles in, a lot of money is being made over the next couple quarters. But then after that, it kind of fades and it comes back down, and the real bull market is still, another year or 2 away. So I would say if you're trading, you're investing in these companies, don't be afraid to take some money off the table when you have big gains. So I'm not skeptical that there could be a breakout here, but I'm skeptical that the breakout will be sustained beyond, let's say 6 months or 9 months. Okay, I have a little bit of time left, so these are some stocks that I own. I'll go really quick. Minorum Gold, they have a discovery in Mexico. This is one that we've been in for a really long time. And technically, this is a good entry point. There's strong support at 50 cents. The company is drilling right now. So this I would say is a buy right now. Triumph Gold is another one. This I would wait to see. They have a potential discovery, but the stock is coming back. We took some profits near the peak. I would wait and see for a couple weeks if this stock can continue to base, stay above 50 cents or the high 40s. If it can and it builds a base there, that's a good time to get in. And lastly, this is Defiant Silver. They just acquired a company. Their new board, Randy Smallwood's on the board. He's going to be actively involved. He's the CEO of Silver Wheaton. They have a great deposit with 35 million ounces of high-grade silver. This company has been frustrating because they really haven't done much over the last year or so. But look for them to raise money and start drilling. They have a great blue sky target. The enterprise value in US dollars is only 23 million right now. You can see looking at the chart, the low 20s is where you want to be a buyer. So this is one to keep an eye on. I think this could get a lot of fanfare in 2019. And that's all. Looks like I went a little bit over. Thanks everybody for coming and listening. I really appreciate it. And